Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to discuss how to model the fair value of a forward contract in the context of a corporate decision support tool for risk management. And the purpose is to more accurately depict the firm's forecasted financial statements and risk, and also to facilitate an evaluation, a due diligence of any derivative strategy that has been proposed. So, all right. For more on derivative strategies, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Lars Tuxelheim and Alfred Vinusson. There's also more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. All right, so derivatives are widely used to take market views and to try to generate excess profits from that. But a better way to build a case for risk management is to design these strategies so as to help the firm secure strategic objectives, which essentially means having extra liquidity when you most need it. So, for example, to meet debt obligations when they are due and thereby avoid various sorts of financial distress. Derivative cash flows can also help secure funding for strategic investments. So there are various ways that derivative strategies can be helpful in terms of executing the sort of business plan optimally. We also know from hard-won experience that they tend to generate side effects and frequent surprises because they are poorly understood, and companies don't undertake comprehensive due diligence of them so that they are informed beforehand about possible scenarios across a wide range of scenarios then. So what you get is typically net income volatility from based on the fact that you have to fair value these derivatives. And the changes in those fair values are you have to report them in net income unless you apply for hedge accounting. And there may be margin calls connected to those. You have to post collateral if your if your losses accumulate on these derivatives, and you have to mitigate the credit loss or risk from the perspective of the counterparty by injecting more liquidity into the trading accounts. So that can be very problematic from a liquidity planning point of view. So these are surprises you run into unless you see the mechanisms behind them and are able to anticipate them. And we're saying here that a corporate decision support tool should be able to do that and allow for that sort of proactive evaluation, right? And you basically want to make sure that across a number of scenarios, then you understand, you're able to anticipate what's going to happen. If that scenario plays out, what is your company going to look like? You want a realistic depiction of that. So you have this model in place, hopefully, that is able to show the forecasted financials in a strategic setting now, connect that to investment plans and various liabilities you have to meet. And this is referred to as risk budgeting, right? We express risk using the financial numbers, and you want this model to have a very high degree of accounting analytical integrity to be a reliable companion for decision making, right? So within that, you can apply different scenarios and evaluate your firm's performance and risk, as well as different corporate policies. If we do this, what happens to risk return, etc. And this is the context in which we're going to evaluate these derivatives, right? But what we find is, of course, that most of the time, these derivative strategies, if there is any evaluation going on, that's usually about the ultimate payoff. So you come up with some slide showing what the payoff will look like upon maturity at the cash settlements of this derivative, right? But if you want to be comprehensive about understanding the various ways in which derivatives affect your financials, you have to look at the net income and balance sheet effects for the entire duration of this contract's existence, right? So it will generate effects from day one and not just at settlement. So you're going to be reporting derivative assets and liabilities in your balance sheet, and the changes in those go into net income, right? I mean, that's how derivatives are accounted for. So we want the model to reflect this. We want the model to be IFRS consistent, right? And just mimic or be very close to what the corporate financial statements actually would look like in any given scenario. So we equip the model with a chart of accounts that encompasses these realized and unrealized derivative gains and losses, and derivative assets and liabilities then in the balance sheet in order to be consistent with fair value accounting. We need those. So here we see what the model will look like. And with this chart of account, we set up these forecasts, which now include derivative gains and losses, as well as assets and liabilities over here. Hopefully we can make this model balanced so that it's self-balancing regardless of scenario, right? That's always the goal. We're adding a piece of modeling now, and we should confirm that we can still make this come out right. So whereas the modeling of ultimate payoffs is quite simple, the same is not necessarily true for these fair values that you want to forecast in the meantime, in all the quarters leading up to the settlement date, right? So that's the question here we're looking at. So what has to happen is that the model marks to market, meaning it values the derivative position in each quarter in your forecast. It's as if we were looking ahead and anticipating doing a valuation on that date, on the balance sheet date. What if we arrive on that day and we see the sort of market outlook or the market numbers, in that quarter are such and such, and that will go into the formula that we are using for the fair value assessment. So we're anticipating doing a valuation on a future date, right? So we need to understand, first of all, what is the right formula for this. If we take any given derivative, that derivative comes attached with a specific formula for valuation. It also means that we have to forecast all of the variables that are included in this formula. I mean, it makes reference to a number of variables which connects it to a certain valuation that you get when you run these values through the formula. So each of those has to be forecasted. It's a two-step thing, right? So you find the appropriate valuation formula, and then you forecast the variables that are included in that formula, and then you just derive the fair value. So you set the model up to do that. So let's take a forward contract. We'll look at options in other videos, right? And if you want to model the fair value of a forward contract, here's the formula you can use. The fair value here is a function of the forward price that you have locked in. And you compare that with a future forward price on the balance sheet date you're referring to, and then you discount that. There's a payoff involved. You have locked in a certain price, but the market turns out a bit differently. So there's a difference. And that is the predicted cash flow that produces a value of this contract. That can be either negative or positive from your point of view. And that has to be discounted back to present time. So here's what goes on. There's a current forward price, which is what you're able to lock in now. And you're doing that with a maturity at time T, capital T here, which is when it matures. It's going to be 1 year in case. There's a period in between here, time T, small t, where we're going to do a valuation of this contract. So we need another forward price, again with maturity at time T, except that now we're talking about a future point in time so that there's less time remaining on the contract. T then is the date of cash settlement when the contract mature, and R is the discount rate. So it's like we're entering the forward contract here today. We're doing that with the maturity of time capital T. And we know that in a number of quarters in between, we're going to have to market this derivative, do a valuation of it. And that's going to be here, time T, when you have to estimate the fair value. So again, we're basically entering the contract here. And this is also the time at which we're doing our due diligence using our model. So we want the model to be able to predict what the fair value would be here at time T. Again, looking forward to the maturity. So the contract remaining is gradually less the further out we move along this time axis, right? So that would be the dynamics. So just to recap then, we have a fair value at time t, which is not the same as the present time. Like we're doing this at time 0, evaluating this contract. And to be able to implement this formula, we need the forward price at that time t, which is in the future then from our perspective, some interim date in between now and the balance sheet, sort of the cash settlement. And we're going to lock in a certain price at time 0, right? And that refers to capital T as well, the 1-year time horizon that we have. So here it's this could be 6 months, but it's a forward contract that matures in 6 months from then on, so you have the same maturity date, except that the starting point is different because we're talking about a forecast balance sheet date, right? And then we, as always in valuations, we discount it back to present time, and that's straightforward. So what are the variables in the formula that we have to lock in then? Well, you have this is given now. We have locked in a certain forward price, the one we can see today for a maturity of time capital T, right? T and capital T are given, deterministic. There's no uncertainty involved there. We can simplify things and assume a constant interest rate. So that leaves the future forward rate as the only thing that needs to be forecasted. So that's what we need to do to implement this. And we know then from other earlier videos in this channel that you can think of the forward price as consisting of the spot price that we see in the market today and the basis, or the cost of clarity, alternatively called. So that will be interest rates, any storage costs. If you're talking about things like gold and copper or oil, it costs money to store them somewhere. Until the contract is supposed to be settled, right? But they may also produce benefits in the meantime while you have them. Like for oil, it could be good to have some supplies secured, right? This is the components then of this difference between the forward and the spot rate. We're not going to details here because we'll cover that elsewhere. So since we know this one, we have to come up with some forecast of the basis rate. But what if we are, we know for a fact that this is going to fluctuate, right? I mean, the market sentiment changes and the interest rate changes. So there will be some volatility in fair values coming from volatility in the basis. There's no escaping that conclusion. But what if we're willing to simplify life and say that, well, okay, we realize this, but it's going to be not the main driver of these fair values. We want to focus on the spot rate volatility. We're going to zero in on that part of it. We could, at a later point, decide to revisit this and make a more dynamic modeling of the basis. But for now, let's say that we want to focus on the spot rate, and then will be what drives the value of future fair values. So that's a simplifying assumption we're going to make. And all right, so numbers then to be able to do this. Let's take a spot price of 49. We're on January 1st here. The forward price that we're able to see on this day is 45. I mean, that's handed to us by the markets. We read about it in the papers, and it's 45. So we're looking at a 1-year hedging horizon then, and we're going to do 3 interim valuations. There are 3 balance sheet dates in between now and the final day of the year. So when we close the books for the year. So there are these 3 points. There's going to be a valuation taking place in our model. We're going to anticipate or predict that valuation, and we're going to simplify them by assuming a constant interest rates. So the contract volume is given. We're just assuming a number here, 500, let's say, barrels of oil in this case. So since we're willing to assume that the annual rate is going to be constant, we can then proceed and make a forecast of the spot price. And we're going to make it so that in Q4, when this forward contract matures, the forecast is 45. So we're assuming that the forward price that we're able to lock in coincides with our forecast. And when you do this, you can then proceed and calculate the basis. And it's 4 on the starting date here, the difference between the spot price and the forward price. What if then, we're going to apply a little trick here to be able to execute this in a simple way. And that trick is to basically just to make sure that the basis unwinds in an orderly fashion, because we know that at maturity, it has to be 0. There's gradually less time remaining on this contract. So as you get closer to time capital T, there's going to be less and less of a difference between the forecast at that future point in time and the one you locked in concerning capital T, right? So that means that it has to converge towards 0, right? And then you can just assume that it's going to unwind in a linear fashion in between, so that we simply multiply it by time to maturity. So starting out, it's a 1-year hedging horizon, right? So it gets progressively less as we move further out in time. So we just unwind it by multiplying with the time to maturity. This is the simplifying assumption, right? That we're just going to focus on the underlying spot price as a driver of future fair value. So if we're willing to do that, then you can simply make sure that it unwinds like this. And taking that, then these are the same numbers that we just looked at. So this is our forecast now. We're looking at this. This is generated by our model or whatever. We have this forecast. We want to, one of many scenarios that we wish to evaluate, for how this fair value plays out in our financials. So then, what next is to use these numbers to derive a fair value of the position, because we know the formula to apply. So we have programmed that formula here, which is the numerator and the denominator. And the numerator is just a difference between these two different forward prices, right? And in this case, it's sorry, misclicked. In this case, it's the difference here between the forward price that we estimate for the next quarter and the one we were able to lock in. And it's going to be 0, right? There is no difference here between those two, the forecasted forward price and the one we were able to lock in, because of this feature where we are just linearly unwinding the basis. So when these are the assumptions, there's not going to be any value to the contract, right? Because they, for all the quarters going forward, they coincide with the price we were able to lock in. So you're forecasting future forward prices with maturity capital T that are the same. But this is one specific scenario, right? But in this particular scenario, that this will be the actual case that there is not going to be any value at any forecasted quarter, because it's just in a very orderly fashion unwinds exactly according to expectations. But that's a special case, right? It's always good to verify this initially and then move on to investigating other scenarios and possibly simulating many thousands of them. All right, so moving on. In this case, we're evaluating a different scenario. Remember that this decision support tool is about evaluating scenarios and the effect of corporate policies. Right? So we have set this up so that we can do this. So let's run a scenario where the spot price increases to 53 in the first quarter and then remains flat. That's the scenario we're curious about. So now it turns out that there is going to be a difference between the forward price that we expect to see on these future balance sheet dates and the one that we were able to lock in. We were able to lock in this, but given that the new sort of path for the oil price, what we believe to be the future forward price with maturity capital T is different now because of the jump in the spot price, and the forward price will adjust to that. right? But the basis is deterministic here, just unwinds as before, still has to converge when there's basically no time left on you know, before reaching the maturity date. So, but again, the spot price will drive future forward prices, obviously. So that is what we're seeing here. So now there is going to be a difference. There's a 5 difference here now between the forward price that we see in this date and what we were able to lock in. So now we have something to value. This is a, you know, source of value here. And we discount that and apply the contract volume. And now there's a contract has value all of a sudden, because we're in a scenario where there's a clear deviation from the price that we locked in. And for us, it's negative because we're a producer of oil and we're benefiting commercially from the higher price, so that the derivative position is going to be making losses. This, from our point of view, is a loss on the derivative contract, showing up here as a negative sort of value on this position. So now we have a fair value of the forward contract. If this were to be, you know, if this is our new forecast, we want to explore this scenario, then we can anticipate that these numbers will show up in our financial statements on these balance sheet dates. All right, so here are the same numbers. Fair value of the forward contract. The change in that fair value goes into net income then, according to the rule that we have to account for derivatives using the fair value approach. So between these two dates, there's the entire amount is the change as well. So that is a loss to be reported in that quota. In between these two dates, there's still a change, but a smaller one. But that too goes into the net income statement as an unrealized loss. And that goes on until the contract matures, when you reverse all the previous, accumulated unrealized gains and losses, and you replace that with a realized effect, which is the cash flow effect from this. You settle the contract, and that's a realized effect. So, and it's fairly substantial here. Now, if you take the first quote, these numbers are not unrealistic, in relation to, we're assuming 100% hedge rates here, and with that, for this particular change in the oil price, there's a 9.2% change in fair value to be reported in net income. That's 9.2% of revenue. So it's a substantial number. All right, so we're going to be happy, but I'm just going to explain why first. So we have the revenue over here. You have the initial mark-to-market effect here. That's a loss in the first quarter. You see further unrealized losses as you move out here, and the price you're approaching maturity. You reverse them while you then experience the realized effect on this contract, right? So here you make sure to undo or reverse the unrealized fair value gain and loss because it's non-cash effective. This one will be, though, because it's realized. Here we're then showing the derivative, the fair value as a derivative liability because it's a negative number. So it shows up here until it matures, by which time there can't exist any liabilities, right? And it becomes cash instead. So it sort of credits the cash account over here. And because we're modeling these liabilities and assets in this fashion, the whole thing will balance. And that's why we're so happy at the end of this. And so we were able to incorporate the fair value changes of this forward contract into the financial statements, which was the goal. And we're able to do so in a way that it's perfectly possible to examine now any number of different scenarios or even simulate them. The model will keep track of the fair values, and it will always send them into the income statement and report them in the balance sheet, and meaning that you then can understand beforehand what's going to happen in different scenarios. That's part of the due diligence, right? And so we have we're in a much stronger position now to deal with or evaluate derivative strategies and make sure we are never surprised. So some conclusions here. These gains and losses are indeed substantial. It was not at all an unrealistic change in the oil price here, and it was 9.2% change in the fair value. As a percentage of revenue, that is. Well, we're also saying that good risk management implies that we do this sort of thing so that we understand across a range of scenarios the impact of derivative strategies. I mean, even in so-called good scenarios, when you're gaining on the commercial side, you can have major unrealized losses that make things complicated for you liquidity-wise and having to report these large losses. So we want to know that what that is all about, before we accept a derivative strategy. So and these fair value estimates, we have to replicate how this process would work in actual life, right? We try to have the model do that, and that means implementing the relevant valuation formulas and forecasting the variables in it. Right? So that's the two-step process we're dealing with. Yeah, for more information, please consult my books. There's also more on riskbudgeting.se on my webpage. Please like and subscribe, and have a good day.